Have you ever found the perfect trading strategy? One that looks absolutely foolproof on paper, only to see it crumble the moment you start using real money? You're not alone. So many traders, both new and experienced, go through this exact cycle. They find a strategy, get excited, apply it, lose money, and then blame the strategy. But what if I told you the problem isn't always the strategy itself? Today, we're diving deep into the real reasons why your trading strategies might be failing. And trust me, the answers might surprise you. By the end of this video, you'll have a completely new perspective on how to approach your trading and, more importantly, how to turn those failures into consistent wins. So, let's start with the most common culprit. You haven't backtested it properly. I see this all the time. A trader finds a cool-sounding strategy on a forum or in a YouTube video. Maybe they look at a few recent charts where it worked perfectly, and they jump right in. This is like trying to build a house based on a single blueprint sketch without checking if the foundation is stable. A proper backtest isn't just about looking at a handful of winning trades. It means rigorously testing your strategy across hundreds, if not thousands, of historical data points. You need to test it in different market conditions: trending markets, sideways markets, volatile markets, and quiet markets. Or is it a strategy that only works when the market is strongly trending upwards is going to get destroyed when things turn choppy or head south? A thorough backtest reveals the true personality of your strategy, including its win rate, its maximum drawdown, and its average profit per trade. Without this data, you're not trading, you're gambling. You have no statistical edge. Next up, and this one is huge, is the psychological gap. This is the massive canyon between trading on a demo account and trading with your own hard-earned cash. On a demo account, you're fearless. You see a setup, you take the trade. If it loses, oh well, it's just fake money. But when real money is on the line, everything changes. Suddenly, fear and greed storm the cockpit and take over the controls. You see a perfect setup for your strategy, but you hesitate. You're afraid of losing, so you wait for extra confirmation. By the time you get it, the best entry point is long gone, and you either miss the trade or enter late, drastically reducing your potential profit and increasing your risk. Or how about this? The trade goes in your favor, and you're supposed to hold it until it hits your predetermined profit target. But greed whispers in your ear, what if it goes even higher? So you ignore your plan and hold on, only to watch the price reverse and turn a winning trade into a loser. Or fear kicks in, and you close a good trade for a tiny profit, terrified of it turning against you. In all these cases, the strategy didn't fail. You failed to execute the strategy. Your emotions hijacked your decision-making process. The very rules that were designed to protect you were thrown out the window because of fear and greed. This is why trading is often said to be 90% psychology. You can have the best strategy in the world, but if you can't control your own mind, you'll never be consistently profitable. Another major reason strategies fail is a misunderstanding of risk management. Many traders think risk management is just about placing a stop loss. Well, that's a part of it. It's so much more. True risk management is about position sizing and preserving your capital. Let's say your strategy has a 60% win rate, which is quite good. But if you're risking 20% of your account on every single trade, you're in trouble. Why? Because even with a 60% win rate, you can easily experience a string of 4 or 5 losing trades in a row. It's statistically normal. If you're risking 20% per trade, 5 losses in a row will wipe out your entire account. Your mathematically profitable strategy has just bankrupted you. Not because it stopped working, but because your risk management was reckless. A professional trader typically risks only 1% to 2% of their capital on a single trade. This way, even a long losing streak is just a small dent in their account, not a catastrophic event. They can lift a trade another day, confident that their statistical edge will eventually play out. Ask yourself, are you determining your position size based on a fixed percentage of your account, or are you just picking a random number of shares or lots that feels right? If it's the latter, you don't have a risk management plan. You have a recipe for disaster. Now, let's talk about market conditions. The market is not a static entity. It's a living, breathing thing that is constantly changing its mood and behavior. A strategy that works brilliantly in a high volatility trending market might perform terribly in a low volatility, range-bound market. This is Kayet's strategy to market fit. Many traders make the mistake of using one single strategy for all market conditions. It's like trying to use a hammer for every job in your toolbox. Sure, a hammer is great for nails, but it's not so good for cutting wood or driving screws. You need to be able to identify the current market environment and then deploy the appropriate strategy. Some traders specialize in just one type of market and sit on their hands when the conditions are right. Others have a playbook with 2 or 3 different strategies. One for trending markets, one for choppy markets, and so on. The key is to know when your strategy's ideal conditions are present, and to have the discipline to not force trades when they are UNT. If your strategy is designed to catch breakouts, and the market has been stuck in a tight range for weeks, what are you doing trying to find breakout trades? You're trying to fit a square peg in a round hole, and you'll just get frustrated. The strategy isn't broken, it's just the wrong tool for the current job. And that brings us to our final point, which is probably the most overlooked: over-optimization. This is a trap that many smart, analytical traders fall into. Here's how it works. You're backtesting a strategy, and you start tweaking the parameters to get the absolute best possible results on your historical data. You change your moving average from 20 periods to 21, and the results get slightly better. You adjust your RSI level from 70 to 72, and the profit curve looks even prettier. You keep making these tiny adjustments until your backtest report looks like a perfect, straight line going up. You've created the perfect strategy, but here's the problem. You haven't created a robust strategy. You've created a strategy that was perfectly tailored to the past. It's called curve fitting. You've basically memorized the answers to an old test, but the market is going to give you a new test tomorrow with different questions. When you apply this over-optimized strategy to the live market, it falls apart because it is too rigid and too specifically designed for a unique set of historical data that will never repeat itself exactly. A good strategy should be robust. It should work reasonably well with a range of parameters, not just one magical setting. When you're testing, instead of trying to find the single best parameter, see if the strategy's core logic holds up across a variety of settings and market conditions. Simplicity and robustness often beat complexity and over-optimization in the long run. So, to recap, it's rarely the strategy itself that's the problem. It's either a lack of rigorous backtesting, the psychological gap between demo and live trading, poor risk management, a mismatch between the strategy and current market conditions, or the dangerous trap of over-optimization. The good news is that all of these things are within your control. You can commit to thorough testing. You can work on your trading psychology through journaling and You can implement a strict, non-negotiable risk management plan. You can learn to analyze the market environment before you even think about placing a trade. And you can favor robust, simple strategies over perfectly curve-fitted ones. Stop jumping from one holy grail strategy to the next. Instead, pick one sound methodology and focus on mastering your execution of it. That is the real secret to turning your trading around and achieving the consistency you're looking for. Thank you so much for watching. If this video gave you a new perspective on your trading, make sure to hit that like button and subscribe for more content designed to help you become a smarter, more profitable trader. Let me know in the comments which one of these points resonated with you the most. Until next time, trade safe and trade smart.